Hey, good morning, everybody from Tampa, Florida. Glad that looks like a lot of people were able to figure out the change, and I think I did a little bit better job this time notifying everyone about the change to Thursday. So, yes, tomorrow I'm very busy taking grandchildren to Disney. Um, so this is a little scary. It's even taking these kids to Disney, but we'll see how it goes. We'll get up at 8 o'clock and hit the park. Okay, so we've had a good week on Twitter, I think. There's a lot of good tweets out there. More disagreement on, I love the disagreements. We have to have these disagreements and these changes, differences of opinion. They're all good. I kind of feed on stuff like that. So, vol targeting, we're never going to get rid of that. I had all those disagreements and outliers, and trade level got into it where I'm doing trade level wrong. My acting career came up, and the turtle quiz. So maybe we start with the turtle quiz. I didn't get a perfect score. I think it's impossible, and I could not find the balance of the questions. There's 100, so we have a few more to get, and I can't find them. I looked through all my archives. So, anyways, let's. What struck you about the turtle quiz and that episode with Niels?
Hi to everyone. I want to say that another happy few hours started for me, and I want to say that I was very impressed by the recent episode of Tom Traders Unplugged, and this episode is very unusual, and I'm sure I wrote it in Twitter, in quote in Twitter, that's one of the greatest conversations about global markets, trading the global markets that have been ever published in recent few centuries, and I really think so, and I'm really very impressed. And I think that maybe even in 100 years from now, this dialogue will inspire people to choose a path of being a trader. And I think it's very useful for all people who are interested in finance. I want to be successful in many other areas of life, and it's really so to listen to this episode periodically again and again. And I wrote in Twitter that with very high probability a person will be rewarded for this. It's very serious knowledge, very important knowledge. And I want to say that I don't care about the score. I'm very impressed, and I think not only I, of course, and it's more important than a score. It's much more important.
Hey, hi everyone. Just like to congratulate Niels on the idea of bringing the questionnaire from the original turtle trading questionnaire. It was amazing. Thanks Niels, and thanks Jerry for the answers.
Cheers, Bruno. Thanks very much.
It was good. I remember answering that ad and then sending my resume in, and then we got the questions, the quiz, and the quiz was 100 true false, but also 5 discussion questions, which I don't remember the discussions questions. I don't know if Covell put that in his book, but the unique part about it was the beginning of answering questions for Rich, which they all had to be answers. All had to be one sentence, and it could not be more than one sentence. And so we, every now and then, once we got up there, they would ask us to, here's a question, and so anyways, I do remember one of the questions was name a situation where you took some risk and how did it work out or how did it pay off? But I can't remember the other 4 questions. But it was very interesting. And I took that test around with me. So I was in the accounting business field, and I was doing audits, and I would take this quiz with me to all the audits. And during lunch or whatever, I would pull it out and look at it. And I just looked at it all the time. And I kept it as long as I could. So we had to send it back in by a certain date, which I did, but I kept it as long as I could and just looked at it like all day, looking at this quiz, thinking I got to get this thing right. And so, anyways, it brings back a lot of good memories.
Hi everyone. Jerry, you've really surprised me this week with your feature film appearance in Me, Myself, Irene. That was very exciting, and I love that the quiz you did with Neil. So it's a really good concept, and I'm so glad you revisited that. And look, just in the context of these marvelous events of Jerry's lives, I think of this term outlier, and I see two significant outliers. That these events themselves could have had transformative abilities for your entire career path. And I know the Turtles experiment was definitely one of these points, but really it was the responding to the ad in the Wall Street Journal that probably set that path in motion. So if you go back in time to think what were the critical key outliers in life, what would you say that'd be?
Well, I think one of the most important things is just to be prepared. So I was prepared. No one has the right to think that something magical like this is going to happen. I would have been happy, with a stockbroker job or just getting involved in the markets in some way. But regardless, I was sort of prepared for something great or something normal because I had read books and studied, and I just fell in love with trend following, and I thought it was the greatest thing ever. Um, so, so, so I absorbed and embraced something that made perfect sense to me. And I just was, once again, it was lucky to see the ad. I was lucky to that Richard Dennis was into trend following. That was a guess. I had to sort of guess. I guess during the quiz, I was given the questions, I was thinking that was probably the case. And I had heard of Richard Dennis, and I had read an article in Business Week about Richard Dennis, so I knew it was a legitimate situation. But even looking at the Wall Street Journal ads, that's not something at my stage would be thinking, oh, that's something I should definitely do. I'm going to find a great job here. It was just sort of all random. My family was very skeptical. Like, why would you want to leave your accounting job and go to Chicago? And so just having that mentality of this could, I didn't know the word outlier at the time, but this could be a big outlier. Um, I've counseled people over the years who had offers that were maybe not that great, but similar offers that were kind of off the beaten track. And I'm like, yes, do it. You got to go for it. Um, and, one of my favorite books was Black Swan. And the my favorite memory of that book is reading towards the end. He offers this bit of advice, which is I haven't read the book in a long time, so maybe I'm not 100% accurate on this, and I've changed it in my own mind. But I think he says something like, his big recommendation is go to New York City cocktail parties. And so what he says he means by that is, stand next to people who can change your life. Stand next to people, meet people, and talk to people who, if they know you or like you, you could really have an experience that is unbelievable. And so I didn't go to a New York City cocktail party, but I definitely embraced, um, something that many people would have written off as just too crazy and too weird. Um, so I think, being prepared and putting yourself out there, and probably I can't think of anything more profound than that.
You've got to tell me how it felt brushing up next to Jim Carrey.
So that was fun. I I was in this movie Me, Myself, and Irene, and I had a speaking part. And I didn't get to spend a lot of time with Jim Carrey, but I did have some lines with Jim Carrey and the Farrelly brothers, and that was quite an experience. So yeah, that was Renee Zellweger and this other actor too, who's become pretty famous, Anthony something. I can't think of his name, but he's on Blackish, Law and Order, and I actually met him, and that was kind of a funny interaction because he didn't remember me, of course. And I met Renee Zellweger as well at the Starbucks in East Hampton, and she didn't remember me either. I think she tried to get out of Starbucks pretty quickly. But it's kind of tempting whenever I meet new people or want to impress people. I ask my wife, can I mention me, myself, and Irene? And she goes, no. So yeah, that's my short career. I've had other opportunities. I was also had a speaking part, an interview or an audition for um, Entourage. Remember that show? I think it was Showtime. It was a really popular show here, and I did not get the part. So I've had some successes and failures. I was on 2 episodes of Spin City with Michael J. Fox. No speaking role. So, anyways, I know I could be a good actor, and I always tell people if you really, my 2 favorite recommendations for young people and their is hedge funds. Try to get a job in a hedge fund or try to become an actor. See, these are just 2 fields where the outliers are right there, and it takes a lot of work, and it's a little bit of luck, and it's a little bit of frustration and drawdowns, but it's really outlier type professions.
Thank you for this great words. Very interesting to hear this. And I want to say that maybe 7 or 8 years ago, I was thinking about establishing a transport company, and I established it, and I failed in this, and I not regret about this, but I was thinking I was trekking near the sea, near the beautiful uh, forest near the sea, and I had a thought. I was thinking about this company, how I will establish it, how I will run it, and I thought, I don't want this company. I want to be only a trader and maybe only a writer. Write books. I like to write something from myself.
Jerry, you were mentioning this cocktail party thing. I don't know if those things are ever coming back, but I do believe this Clubhouse included lets you connect with people who can change your life or change your mind. Both are extremely important to the development. I can honestly admit I'm only in the position I'm in today because of the people that I had met, whether they were at a birthday party or through other friends. Uh, it cannot be underestimated. Meeting good people who maybe see something in you or you have something in common that can open doors you wouldn't have imagined.
Exactly. And I just want to throw in there. There's a lot of smart people, that I follow on Twitter. They're And I don't know why. It's just this week or so they just feel this. Some of them feel this need to rip on Clubhouse. I mean, Clubhouse is fine. I mean, it's fun. It's definitely. I loved it when I first logged on, and I thought it was amazing. And it just for, having discussions that are not Twitter conversations about trend following can be frustrating because I'm not that articulate, and I don't choose the perfect word, and then people just can't keep up sometimes, or they have their own opinions. So talking it out, yeah, I thought this is a good idea. But recently, I've been people just post this stuff like, "Is Clubhouse still around? Whatever happened to Clubhouse?" I'm like, "What's wrong with you? Why do you even care?" And it was kind of this restrictive thing for a while. Maybe that ticked them off. But I knew from the very beginning that if you already had a microphone, a podcast or a webinar or a real popular blog, then it probably wasn't going to be something that you would embrace. Why would you? You have your own thing. Credit to Niels. He participates sometimes, and I participate, and I have other venues sometimes. But it just seems to me that it's just a little bit of jealousy to bash it. I can understand if you don't like it, but just to throw things out there like, look how cool I am because now I'm laughing at Clubhouse. I just don't get it. So stop.
I want to say that it's very important to believe in your dream and to be prepared in your dream and to go into the direction of your dream almost every day. And this knowledge that I get from Niels and Jerry and Moritz from Tom Traders Unplugged and this clubhouse session, it was my highest dreams. I have dreamed and I believed and I didn't even know how I can achieve it, but I believed that I will, and I dreamed for many years, maybe um, 7, 8 years. I was dreaming about this. And before that, I was dreaming only to be a rich person, successful trader, because I started to trade in 2007. I have some interruptions in my trading career because of ruined accounts, but in 2013 I decided to go into the direction of my dreams, to have clear goals and to be happy with this and not put the money. I understood that the money must not be put in the first place. The first place is a process, and of course, a relationship with the people. It's very important, and the money is not if you have it or not, but it's not the first place. Of course, it's important, but not the first place. I'm sure.
Hey guys, Avi here. Jerry, thanks again for leading the call. I'm going to reiterate the cocktail hour in New York City. As someone who's lived in Manhattan since 2002, I totally agree. Just how many unique interactions and opportunities you can get just by connecting with people. And I think it goes both ways. People want to meet you. Like if you have something interesting to say, if you have something interesting you've done. People want to talk, and I think that's just the nature of it. And it's not like a mechanical networking event type thing. It's like much more organic and meeting people in a much more natural way. So I think that is definitely true. The other thing I'll add, you said you're going to Disney. I took my daughter to Disney World August 22nd through the 29th, and they did a fantastic job with COVID. So I think you'll be great, and there's some amazing rides if you haven't been in a while.
And one question to all of you guys: do you think that being older changed the way you live that kind of outlier or black swanish life as you get older?
Yeah, I think that's a good point. I don't think it's any coincidence that all the turtles were in their 20s, and maybe that's the majority of who applied or who would accept the low salary or pick up and come to Chicago with kind of maybe it looked a lot more risky if you were in your 30s and with children or, even older. And yeah, I'm slowing down. I never understood why it was just sort of I never planned to retire when I was like loving my job and trading in my 20s, 30s, 40s, 50s. I never planned on retiring. I don't plan on retiring now. And I don't think I work a lot. I don't think I've slowed down too much, but I probably have. And, but yeah, and then none of the turtles were married either. So I guess I'm answering that question. You're probably more prone to be able to do what it takes to take advantage of good situations with when you're younger and then not married. Not, I don't know. But shortly thereafter, everybody started getting married. So pretty interesting.
I think it's very important to go consistently in the direction, as I have said before today. I think very important to go consistently into the direction of your dream, and maybe, of course, as we are getting older, I think it's we get more knowledge, but not all of the people, in fact. So there must be a clear direction of where we go.
I personally feel that life is a very path-dependent process. So the events you participate in your younger life tend to be where you compete best. And as you age and go into these different regimes of your life, your edge changes over time. So unfortunately, I'm at a position of my life now is sort of it's getting to the waning years of it. But where I do believe that I personally have an edge is an experience. So within that context, I'm looking for my outliers within the domain of experience, as opposed to maybe the domain of actually actively trading. So whereas I regret sort of not getting involved in trend following in my early years, where I could have benefited from the compounded nature of these returns over a very long time. I've sort of had to look at where I compete best now. Once I sort of understand this philosophy, where do I compete now? And it's sort of a trend following philosophy, but it's applied to life as opposed to trading, where I say my edge resides in diversification across this area of life experience where I am diversified.
Yeah, I find it amazing how we can apply trend following principles to life itself. Take small bets and bet in everything you can, so that you may find an outlier that changes your life, that changes your account, and both your account and your life.
I'm sure I have all this in Twitter that I'm absolutely sure that a mindset of trend following trader is a mindset of a successful person in general. Successful person has clear goal. Successful person has he's very consistent. Successful person believes in what he does. Successful person have a patience and much more, a lot more than that. I'm sure.
I am in that part of my life, having my first kid, and I knew when I was younger I would be able to take more risk, and that was, doing a startup, or taking jobs overseas in mainland China, or trying to do small projects in Korea, or however. I don't see that happening now. Um, it's you got to play a bit safer, and it's just like, I don't know, your retirement portfolio or whatever. It's better to take the bigger, riskier stuff when you're younger. And if you're not, that's kind of a mistake. Or rather, your risk reward gets worse.
Yeah, the risk of ruin gets instantly larger, right? You get instantly much more risk averse because so much more is on the line. But I still think that regardless if you're young or old, this mindset of taking small bets and spread them across all the possibilities is key.
Yeah, it's interesting how this goes contrary to everything you've been taught, whether it's in school, especially in the corporate world, where accuracy, not swinging for the fences is really rewarded, where stability is the name of the game. So it runs contrary to everything. One of the things that I've kind of noticed is it's really the flexibility in your thoughts and not getting ingrained in that institutionalized way of thinking. I think if anybody has spent a decent amount of time in the corporate world, they'll kind of know what I'm talking about. That's the hardest part. So I don't know if it's obviously, you potentially have some kids and marriage and all that stuff in your 30s and 40s, but I don't know if it's just that or the fact that you've kind of embedded into a way of thinking that's very static, that's very mundane, and you've been doing that or thinking that way for the last 10, 15 years on your job or through school and so forth. So it's definitely refreshing to hear, that you can apply this theory or this mentality, perhaps to something else, and make what you want out of it.
There's one thing that everything that was said before is really very true for me as well. There's one thing that I noticed actually that happened throughout my career. I mean, my late 40s, and when I started, you really had to join the big banks or the big institutions if you wanted to be in this business. Had to sort of make it, and concentration was very knowledge was very concentrated in a few hands, the few heads of desks and things like that, the few jobs, the few roles. Then things started to, decentralize, and now we have, all sorts of platforms to access all sorts of people. So it's very easy to network and get in front of people that matter. And once again, thanks to Jerry and Niels for setting up all these wonderful tools and appointments and channels through which this specific knowledge can actually freely flow and reach everyone.
I agree with that. Look, we're participating in this clubhouse with Jerry Parker, Niels, Moritz, all of you people who've got this amazing experience. And really what we're doing is we're recreating the turtle experiment in clubhouse form. So whilst we sort of look back sort of with glazy eyes at this magnificent turtle experiment, we've got the opportunity right here to pick the brains of some of the best traders we have. So I'm so privileged to be here, and I think it's a great venue.
And I just wanted to say thanks, because it feels like you guys are speaking to me. I'm in a situation where I just have my newsletter ready to share with the public, and I was invited to a wine tasting, with the Princeton alumni. And as of last night, I was like, I don't really want to drive 45 minutes and go. And after this talk, I mean, I'm definitely going because of the cocktail party experiment. And, we'll see what kind of connections get made. So thank you for sharing all your experiences. And you don't always know how it affects people.
Oh, that's good to hear. One thing I thought about a few minutes ago was this book, another book I really like, that I think it's a pretty good book. I know when it came out, it got some good reviews, but then I think over the years, I think people don't like it as much. But I liked it. It's called The Innovator's Dilemma by Clayton Christensen. And it talks about why small, young firms sometimes end up beating the established firms. So why do these young people, when you have men and women who run companies and they've been entrenched with market share and dominance of their industry, why did they lose to young people, younger firms? And I think it's just the problem of you have too much to lose. And if you have too much to lose, then you're not going to let it all hang out there. And you must be able to take this risk at the right time, and pursue this crazy dream. And a lot of them will, like our trades, will fail, but some of them will turn into big winners, and you leave people behind like, why didn't I do that? Because you looked at your life, you looked at your company and said, well, if I do the right thing, the hard thing, the new thing, the crazy thing, then how is that going to impact what I already have? So I think that is a little dilemma. And even with me, I'd like to raise some money in my fund, and I think, I don't think this is going to happen necessarily, but this is the path I'm going to choose, which is redouble my efforts on hunting the outlier, and further be less concerned than I ever have before by volatility of my open trades. Why? Because no one else was willing to do it. No one, people who don't have anything to lose and look at the market and say, well, that's a really, no one's doing this. Why don't I, as a young person, step out and be different? They don't agree with that idea of making your bottom line, hunting those outliers. It's almost like no one on the planet except a few people, um, and a lot of them are on this call, have a 100% commitment to classic trend following that lets the profits run irrespective of the volatility of those profits, not protecting equity capital. Like, I'm a fiendish about protecting my capital. I just define my capital as my equity, apart from the open trades that have big profits. So I think that what do I have to lose? I've already made enough money, and maybe if someone comes along and says, "Well, you're pretty different, and no one is really doing it this way. I understand it. You're a good fit with my other more conservative type traders and trend followers. Maybe this is something that you could." I think just the whole idea of being different and embracing being different, especially when you think it's right and it is something that's good for people. So I encourage everyone to look at it in those terms. Like, over the years, I've said this before, I've met young traders and I'd say, why are you doing this? I said, this element of your system is wrong and you should not do that. And their response was, I know it's wrong. I know it's not going to work, but this is what I think would attract clients. And so I'm like, okay, once you get the clients, once you get to a certain level, then you're going to start trading properly. And they're like, yeah, that's pretty much it. So I'm going to sacrifice fitting in and doing what people expect me to do. And then later, if I survive, I will go back to doing what I think is the actual correct thing to do. That's kind of silly.
It
I
sounds a
think
bit nuts.
that speaks of experience, Jerry. So, whilst we say that no one thinks like we do, that's from the context of experience. In that, people without experience who trade these markets have an expectation that markets are always profitable. But we know by experience that there are certain periods of time, infrequent, unpredictable periods of time, where markets are incredibly volatile, way beyond our wildest imaginations. And they're the transition events that you can actually make significant money out of. So the majority of people want to make their constant, consistent expected return, and they'll use every system and every technique available to smooth that curve because they want this consistency, this cash flow from a market that doesn't deliver cash flow. The market delivers investment returns. It doesn't deliver cash flow, but the expectation is that it's always profitable. So I think that's where, as we get older in years and more sage, we start. In hindsight, we look back over this amazing track record and see all of the mistakes we've made over our life. Realize that it's a handful of opportunities that, if we had been there and participated in them, those handful of significant opportunities are enough to make our wildest fortunes. We do not need this expectation of consistent wealth over this path. But to achieve those moments in time, you must have a volatile equity curve. It's a necessary accompaniment to the wait or the patience that's necessary to catch these monumental events. But I think that's something that experience gives you. And why we can say that now in our years, your sort of notion that now you're going to more aggressively hunt outliers is an expression that, as you've sort of got to your point of experience, recognize that it's those salient features that have been responsible for your success. So why not go for more of them?
I well, I have some caveats, I guess. Um, I think that the idea of sizing your risk also applies to this life. As your risk gets higher, maybe you need to adjust your close position equity, and then I think that there's like a hump. You're going to protect that equity as you go up, but then as you become more successful, more prominent, or more, I don't know what you want to call it. I don't want to say rich, but basically, then the utility of that wealth becomes less. When you need that dollar, you need that paycheck, you need that type of things, then you become extremely risk averse, because losing that, you're going to have the high volatility. But if that high volatility puts you in a homeless shelter with your kid, that's a totally different story. Then it doesn't really affect your life. Okay, maybe you downsize your house or something, but you still have a roof over your head. You can still put your kid in school, and you can still feed your family. Um, I, it's a bit hard, I think. And for all of us, I think we're all well educated. We all have these types of opportunities, but um, I do think there is kind of like a threshold.
I hear where you're coming from, Derek, but I think this need, this desire to pay the mortgage, this desire for the need for wealth, puts all of these additional pressures on us, which make us behave in a manner that is inconsistent with the way the market works. So we tend to be quickly disaligned with what the market does, with our expectation that we need this money to satisfy a lot of things that is really should be free from our considerations when we're a speculator. So, we don't, for instance, participate in speculation if we've got limited capital we can't afford to lose. We must therefore have a sufficient level of capital that enables us to benefit. We must trade a sufficient small size that we can sleep at night without getting ulcers and making us do these incorrect discretionary decisions. So the risk moments must be managed, and we can only do that when certain conditions are met. So you effectively need these golden rules of prerequisites before you can freely trade as a trader without these additional sort of influences undermining your process.
So one thing I've noticed, at least in our industry, is that the larger funds they become more risk averse. At least that's kind of my experience. But what I really wanted to do was to ask Jerry if he wants to know which 6 questions he got wrong.
No, but I think I might have been gotten some of them wrong with the ones that you asked. The 60 some that you asked. I don't know if I got those all correct, and I don't think you can trust Andrew, because see, like Andrew put that out there a year or 2 or 3 ago, and then he called me up just sometime after that and said, "Hey, will you look at my answers and see if you agree with them?" And I went through, and there was a couple of answers I disagreed with, and I think he changed them to my answer from his answer, but I'm not sure. And I don't even know if my answer was correct. I mean, he may have had it correct. I told him to switch it. Now it's wrong. I don't know. So I think it had probably something to do with spreading. I think there were a couple of, maybe that was one of your questions too, spreading. I don't know. There was a couple that I really, and then once we got there, we went through the course. Rich gave us the test again, and I missed a couple again, probably the same ones. So it's just totally makes no sense whatsoever why I couldn't ace this test. I don't know. I don't know how other people did. I know they wanted to hire people who did well and then hire people who did poorly. So I did really well. And that's probably why I got the job. Once again, my background wasn't playing blackjack or poker or backgammon. And there was an actor. I wasn't an actor at the time. I'm kind of still not now. But here was I, just this boring accountant. Okay, he did well on the test. We'll hire him. So lucky me.
Go on, Niels. Please tell us
Yeah.
those 6 questions, because it wasn't so straightforward. I had difficulties with some of them, and I need to know the ones Jerry got wrong.
Well, I think actually, I think first off, I think Jerry, you definitely aced it. I mean, because some of the questions, I think it's very hard to know whether it's true or false. It could probably be both. But I'm happy to share the ones that Andrew, at least from his interaction with you, but at least the ones that his system recognizes as being different to the answers that you gave. So here goes. So the first one was question number 12. And you answered false to this. And the question was, the majority of traders are always wrong. So Andrew in his system has that to be true. Question 16. So you answered true to this one, Jerry. Under trading is almost never a problem. So he has that as being false in his system.
I'm pretty sure that
Could be the word almost.
I think that's pretty sure that's true. And I think that was one of those things that they really talked a lot about. Trade small, but then, like I said, once we started trading, the bigger you traded, the more rewarded and the more positive feedback you got. So that was kind of like, what's going on here? I know there was one question, one of these questions that they sent out once that we had to answer with one sentence. And I didn't understand this question, but I think the second part of the question was, or trade smaller, or, or risk less. And I was like, well, okay, then that's the answer, because that's what they always would say is trade small, be very concerned about your risk of ruin and things like that. So I'm pretty sure that trading small for most of us is not going to be a problem versus
Yeah.
trading larger.
Well, we can always ask Andrew to update his answers. Question 37 here, you answered false, and the question was trading stocks is similar to trading commodities. So he clearly has an answer in his system that's true.
That's good,
No, I don't
actually,
know.
because Jerry actually did say, whilst he would have answered false in the question, he would have changed that to true, I think, if I remember back to your podcast.
So maybe he didn't. Maybe you did change that, Jerry, to true in Andrew's quiz. All right, question 54. The answer was, Jerry answered true. The question was, the more bullish news you hear, the less likely a market is to break out on the upside. And Andrew says in his system that's false.
Yeah, I misspoke on that one. I think that is definitely false. The more bullish news you hear, the more likely it's to break out.
Yeah.
But probably a reason we lose on 60% of our trades.
Sure. The next one was question 55. You answered true, but Andrew says it's false. The question is, for an off-floor trader, a long-term trade ought to last 3 or 4 weeks or less.
Okay, so that's 1983, and the systems we were using were pretty. And I think you compare that to an on-floor
Right.
trader who holds positions for a few minutes
Yeah.
and probably doesn't take home any position. So I think I got that one correct.
Yeah. And then the final one was question 61. You answered true. The question was, off-floor traders should not spread different delivery months for the same commodity. And he says that in his system that's registered as false.
See, I told you I don't understand this spreading stuff.
No, the spreading.
It
Well,
totally
at least we
confuses
have.
me.
Well, at least we have Moritz on the call today. He knows everything about spreads. So, but anyways, those were the 6 that at least Andrew had a different answer for.
So we can get into a controversial subject here. Switch gears a bit. So just I just want to make sure I was understanding Derek correctly, and I would just say that um, the way that I look at it and the way I trade, I and this is just me repeating myself over and over. I can't stop repeating myself. Is that I see no risk at all in letting my profits run and having lots of open trade volatility. The risk is how do I define my trade level and how much am I risking per trade? 1 or 2%, that's too much for me. 25 basis points, then that's not too bad. So I get my initial investment of $1 million and I'm risking 25 basis points on these trades. I'm not getting whipsawed very much. My stop loss is not too close. And but my trailing stop is not close either. And just after a while, I'm going to start building up some open trade profits, and I'm going to let those things really fluctuate. But I'm killing off these losing trades with a 25 basis point loss. So almost no matter what happens to my open trade equity in Moderna, natural gas, UK natural gas, Tesla, Bitcoin, it's fluctuating like crazy, but I've still got that $1 million plus probably a little bit more. I could be up to $1.2 million with open trade equity. And so, but I'm intent on protecting that initial investment. And of course, the initial investment, I'm going to increase it as I have realized profits, or I'm going to change that number as I absorb the realized profits and losses. So I think that we have to make this distinction between the two. Um, if we're up 50% and it was all open trade equity, and now we're back to 1 million, that's a pretty big drawdown, but not really. Not according to Jerry, and not according to what I consider to be the only reasonable explanation or characteristic and result of letting your profits run. These things can happen, although your capital is still the full amount that you started with, or maybe it's even a little bit more than that.
But here's the thing that I don't really understand about this way of thinking. So, and let's step back from trend following to business. Like, you put on your old Jerry hat, accountant, trying to kind of look at how a business was working, and effectively you'd be going to a businessman and saying, hey, you have two kinds of equity. You have your initial capital, the one you list in your accounts as capital, and then you have your retained profits. These two things are different. With your retained profits, you're free to gamble as much as you like. They can go up and down. Of course, you've got some stops and some criteria, but this is sort of free money. It's on the house, and that is the part I don't really understand, and that is the part that pushes me to effectively be seduced by the heterodoxy and by the and by vol targeting and sort of trying to manage that open profit while trades are still going on. I really don't understand how we cannot treat equity as one account, because at the end of the day, our capital is our capital. It doesn't matter how we contribute.
Bruno, the way I see it is it's a bit like playing baseball. So there's the mechanics of baseball, which is a business of baseball, but the person, the batter, he's there to deliver possibly that home run. So all of his steps taken at the point until he sort of hits that ball are sort of defined by his mechanics. His system really sort of specifically defines how he's going to hit that ball. But as soon as he's hit that ball, there's nothing more that we can do. We let that ball go to wherever it lands. So it's a bit like an entrepreneurial mindset where in a business, there's the day-to-day running of the business. And that to me is sort of managing your risk. It's cutting losses short at all time. But the actual fruits of that business are the entrepreneurial elements of that business. When the new technology, which, we've invested capital in this new technology, we don't know how that's going to go, but then we release that new technology. That's that possibility for that outlier. The business itself, we're managing the cash flow, the capital of the business. But once we release that new technology or that new entrepreneurial initiative into the market, that's a possibility of getting the home run. So that's how I view trend following. We in sort of splitting it into two concepts, that which we can manage and that which we can't. But what we can't do is where the market delivers bounty from its uncertain character.
I understand that. What I still can't fully fathom is how volatility on a certain type of equity is okay versus volatility on initially paid up capital or whatever your contributed capital is not okay. That's why when I trade, there's obviously stops and there's obviously ways to protect capital, but I don't make a distinction between capital at risk, meaning capital that should hit my paid for capital, sorry for the play on words, but it's really this concept, versus capital that comes from, traded profits, compounding traded profits. We talked about compounding last week, and I totally agree with what Richard was saying about it. We are always compounding. That's the nature of the game. We don't live in a kind of additive world. We live in a multiplicative world. Every time you grow a little bit, and it sort of tend to reinvest those profits. So that's why I'm saying, trying to sort of distinguish these two capital accounts is hard for me. I mean, this is where, when I do things, I deviate from the classic way of doing it. I cannot bridge that gap conceptually, and obviously it's a limitation of mine, and I understand that, because backtests say so. The only way to maximize your bank account is to just do what Jerry does. But I think at some point, and the cool kids of game theory call it minimax regrets. We sort of have to minimize that maximum regret that we feel associated with losses. And it doesn't matter if the losses that happen earlier on in a trading cycle, or a bit later in the trading cycle when you have a cushion of built-in profits. But this is just my take on things, and obviously I'm not trying to sort of push the message that I've got to figure it out, because I don't. And then on top of that, there's also, we talked about a few weeks ago about how you measure volatility, which is clearly deficient and needs a lot of improvement. So it's I understand why vol targeting is controversial, but it's not controversial in my opinion as a practice. It's controversial in the way it's been implemented, because it's not good.
Look, to me, it boils down to what is the geometrical expression of that equity curve on an uncompounded basis. And that to me says that trend following, by virtue that it attacks these non-linear features in the market, the expression of its equity curve, provided it's got positive expectancy, is a non-linear exponentially rising curve. If you plotted the exponential graph through that volatile equity curve, you want to see that asymmetry in the uncompounded curve. So when you compound that geometrical series, you get a higher exponential acceleration of your net wealth over time. I think that is the critical glue that makes our model superior to convergent models, because the underlying uncompounded equity curve of a convergent model tends to be far more linear and less non-linear than divergent models. And I think we squeeze extra juice out of this path dependency under compounding, if that makes sense.
It does, and I want to make sure that perhaps I'm not very good at expressing myself, and I've misled you all. I'm not saying that the underlying trading strategy needs changing. I'm saying that. So in other words, yes, very much so. We want that positively skewed distribution. All I'm saying is, and I know that Jerry really didn't like this comment, but the comment I made was, there are times when you really need to protect your open profits, and those are actually, and trying to kind of find that timing, act on that timing, it's really, really hard, if not impossible. So, I understand, and perhaps I'm talking nonsense because I'm describing an impossible object, but the underlying philosophy of vol targeting and effectively even value at risk, which was the way banks allocated capital to different trading businesses, was that when things are perceived to be a little bit more risky, apply the brakes a little bit. Don't go into a 90 degrees bend, with full throttle applied, because probably your car is not going to make it out to the other side of the corner. So the principles, I think, are sound. The implementation is far less. And I'm saying that the reason why classic trend following is superior, because you can't argue with results, you can't argue with success. The reason why it's superior is probably not because of it's not down to philosophical superiority, but actual, pragmatism and the way you can implement it. And as Jerry keeps saying, have a stop loss and just let your profit run. And that's easy enough to understand and follow. So that's what I'm saying. I mean, I think the biggest problem is how you add this layer of complication, which is useless unless you're really good at doing.
Just typing away here. Yeah. Yeah, you took away one of the things I was going to say, Bruno, which is clients don't like it. Clients won't understand it. It's just that the back test likes it. So I think you said that. So that's the problem, is we're always going to be fighting ourselves and our clients because we really dislike certain parts of our strategy that really work well. And that's kind of the reason I think it kind of works. It's the old cliche that if it's hard to do and people don't like it, human nature, then this is probably why taking small losses and letting your profits run kind of works. And I think another thing, I've got to piece in my thoughts here. Um, as I said before, in the long-term trend following back tests that I've done for a long time, 10 or 20 years, after a few months or a year of your back test, you'll see that the drawdown in your closed equity is always less than your open trade equity. So whatever you have in open trade equity, it exceeds the amount of your closed equity drawdown. So if you're trying to, if you want to get this magic of the trend following, and when that requires you by definition to treat the winning trades differently from the losing trades, and that's going to require you to take closed equity, open trade equity, and the total equity, all of this into consideration, and understand that it's okay to do that, and you want to do that. Then, in order to get this um, situation where you can kind of say that there's no drawdowns in this classic trend following if you're trying to protect your capital. And I don't see how in the world you can, with trend following, kind of um, assume that that you don't want to look at these closed equity and the open trades differently. But your first two rules are acknowledging that you're going to treat open trades different than losing trades, and thus you're going to have why not also assume that you want to keep the total of those two separate. Here's my total of all the losing trades. Here's the total of all of my winning trades. From the get-go, I'm treating them very different. Doesn't mean you have to do that. I'm just saying that it's been around for a long time, and we're not the first people to kind of figure this out. And I came up with this question, which I don't think anybody, no one ever embraces this idea that open trade equity is always greater. Every single day of my life, open trade equity has always been greater than the drawdown in my capital. I think that's like the smartest, funniest, most wonderful thing ever. Okay, so I got another one that no one's going to understand either or be very impressed with. And that is, I came up with this question on Twitter, and no one would play along with me. And people criticized my question. But and the question is, I think this gets at the heart of the problem. What is the risk? How would you measure risk if you had a system that had no losing trades? It was tremendously volatile. Oh, I mean, it's the most volatile. The open trades are crazy. You just like never get out. Um, but it never has a losing trade. And so people would say, it's not robust. No, let's play along. It's a game here. It's a totally robust system. We're not holding on to losing trades. It never has a losing trade for a minute. All the trades, when you put them on, they're immediately profitable. And so the risk in that is zero because I never have a losing trade. Well, that doesn't exist. What about 10% losing trades? So the whole problem is that people don't want to go there because the current ways of measuring risk, they don't include any acknowledgement of how many trades are winners, how many trades are losers, what's the size of the winners, what's the size of the losers. It's all sharp, it's all performance statistics. So we can't go there. We have to belittle this question and attack the question, because now you're logically making us look at this. Oh my gosh, exactly. I need to look at losing trades, winning trades, average win, average loss, which sharp and performance statistics, return statistics totally ignore, because it's a slippery slope. If you're going to acknowledge the question has merit, then I'm going to be asked, well, what happens? What's the risk? How would you appropriately measure a system that had 60% losing trades? And we can't go there.
But can I ask a question that perhaps is very controversial to sort of add on top of your question about this system that never loses? What if you're dealing in levered instruments that are mark to market every day, and you need to post margin for? Could you not? Wouldn't path dependency then become relevant? And aren't we trading futures that have daily mark to market, and you have to post post collateral every day for? So your question slightly shifts. I understand what you're talking about, but now the complexity of our reality is not only we have to deal with regret and the fact that we don't like losing, but we really have financial consequences in just being hit by mark-to-market losses, which aren't real capital losses, but happen every day, and you sort of need to do something.
Yeah, I trade pretty small, so I don't have issues with margin. And another thing too is that I haven't been very clear about this, because you said something else that I wanted to talk about. You said, I can't find my notes, but you said at some point in time you need to take these drawdowns in your open trades seriously, and they are material. And yes, I agree with that. And so, like, I'm sort of saying, don't pay attention to the risk part. So the risk is those losing trades, and how many, what size, your win percentage. You're putting down $1. You just put down $1 to make 3. However, I'm very concerned with these drawdowns as it relates to the numerator. And I agree, there are times where I'm going to get out of a big trade like UK Nat Gas that just had this ridiculous run up. But I'm not concerned about the volatility and the denominator aspect of that trade. I'm only concerned because it's a winner, and it's not going to turn into a loser, knock on wood. But I'm very concerned about making money on this trade and not giving it all back. And when this drawdown happens, my brain doesn't call it a drawdown, because that insinuates risk. The trade is a winner, but my brain says it's profit give back, and that's the numerator. And I'm very concerned with that. So I am going to have not vol targeting measures, but I'm going to have, out of the untraditional trend following, let's say, ways of capturing that profit and not giving back that entire outlier.
Hey Jerry, just a follow up to that. So, like, is there like a fixed ATR number that if the stock pulls, or if the instrument pulls back a certain number of ATRs, that you're saying, hey, this is when I'm going to close it out? Or is it more of a feel, or these markets? How do you make that decision?
I'm not going to give you my secrets, but I don't like using ATR as a trailing stop, or in the way you just described. But a few weeks ago, the other Bruno and I were talking about this subject, and it sounds like he and I have a very similar way, shockingly similar way of handling these type of things. And I think another small part is that this is a type of sort of what I call systematic discretion. That it's a rule, but rules that don't have sample size, I'm not a huge fan of. But it's okay to have them. I just don't brag about them. And I think it's okay in this situation to have a small sample size because it's really kind of a system failure. If your trailing stop is wonderful and the back test says it's great, then you're hoping that you don't have to exercise this rule that really is infrequent. You like it that it's infrequent. You like it that your system doesn't need this crutch, it doesn't need this help. But you're going to have this thing. It's sort of like the cutback rule when you're losing money and you say, hey, I've got this great rule, trade smaller, get out of half my positions and just preserve capital and stay in the game. And then later I'll decide somewhat discretionarily how to start putting positions back on. And this is sort of the same thing. These are the sort of things you want to put into your system that prevents you from, from ruin, whatever that level of ruin you define is. And it's fine if they have a low sample size. They should have a low sample size because your system should be good enough to where you don't need frequent systematic discretion.
Yeah, at the time I'm running some back tests exactly on this topic. The usual exit would be your breakout exit, I would say. I don't know, 50-day low, 100-day low, whatever. But sometimes your open profit is so large and it has moved so fast that you don't want to give it all back because your default exit is too far back. So you have this, like Jerry said, this fail-safe rule based on the open profit or on the price movement.
I think what Brian was saying in our discussions before is that this chandelier-based exit is a means to at least sort of progressively trail behind those extreme profits. So we're not giving it all back when the trend ends. We're certainly taking a major chunk out of that outlier with those trailing stops. But I think this whole expression that we don't want to let all of that profit disappear. That is a human brain speaking, and to me, that's exactly the time you need to stick fast to your system, because that's exactly the time a predictive mindset starts taking over, saying, I want to do something. I want to take some profit off the table. But the whole principle of an outlier is that you do not know how long they're going to last. And it is these windfall events that give this non-linearity in the equity curve to the upside, as opposed to convergent models that give the non-linearity in the equity curve to the downside. The risk is to the downside with non-linearity. The risk is to the upside with non-linearity with trend following. So Jerry's first point, which he said he never finds people argue with him about, is exactly that principle. His unrealized equity always sits above his realized balance. And over the course of an equity path, that geometric nature where the unrealized equity always sits above is a reflection that non-linearity exists to the upside, which means that when market conditions get extreme and you start venturing out to the tail events of the distribution, there is far less risk associated with our foray into this tail event territory, because we get the beneficial non-linearity expression of those tail events, as opposed to a convergent trader who gets all of the negative non-linearity of those tail events expressed in his equity curve.
Sorry, just on the topic there of back testing and letting profits run and cutting losses, I was wondering if anybody did the following research. Briefly just started, but didn't get too deep into it. But let's say if we can agree that the breakout bar or day or whatever is an important event, which essentially triggers you long in this case. Has anybody cut a trade if at any point in time before your trailing stop overtakes that bar. If you just cut the trade if the price closes underneath that breakout bar, my assumption is that would, obviously reduce volatility, or not volatility, rather, but drawdown. You'd be taking a lot of small losses. Your profits would probably be a lot larger. So in concept and theory, we're sticking to the trend following concept here. Obviously, the cost of commission and taking 3 or 4 or 5 losses with lower accuracy rate might bother some. But I was just wondering if anybody did work on cutting those type of trades short, as opposed to just letting it wither away to your initial exit loss, which is set at a few multiples of it.
I certainly have done research there, but where I came to the result was that when I initially take my trade, my initial stop defines a maximum excursion away before I get triggered out. But immediately from that point onward, there's a demand placed by my trailing stop to progressively ratchet the position in the direction of the asymmetry you're targeting. So what that does is I'm sort of defining my risk. It does adjust with volatility, but I never go backwards with my trailing stop. So it's this chandelier step up, but it does open and close with the volatility. But I found that was the most profitable. Well, it was the most successful outcome. And all of the tests I've done where I've looked at just working off an initial stop and having a predefined profit target, just using an initial stop, having different types of trailing mechanism, but requiring a particular ATR move in profit before the trail moves. And I think it's a principle that provided momentum basically sticks in your direction in general with some breathing room, then the trade is still valid.
Fair enough. I guess my question is just in terms of, if let's say we're going long, and it's kind of hard to explain this without a chart in front of me, but if we're going long in a 100-day breakout, right, and it's a decent sized bar or whatever the case may be, move, and let's just say your initial stop loss is 3 or 4 ATR away from that, right? That represents your maximum loss, and obviously your trailing stop is at some point there or behind there, depending on what you use. If the market closes below your breakout bar, or maybe this is a discretionary part of me, but isn't that an argument that potentially that trade is no longer valid and that breakout has failed? So if you were to close that trade then, as opposed to letting it hit your initial stop loss, which is multiples of ATR away, what would the results look like over a large sample size? Would you be, saving yourself a little bit on the drawdowns? Because in theory, you're essentially cutting the trades that are not working out quite quickly, and you're letting those profits still run. Because if it is a good breakout, in theory, that market should not look back. That's I guess what I'm trying to determine here.
So I've never done that specifically, Boris, but I think what you suggest is, I think, quite natural. If you look at charts, if you have a breakout and it fails, often you see a reversal, and that reversal will take you somewhat lower, and therefore you say, well, then I might as well get out. So it's obviously a probability study that you can do and see, does this really add up. But I think to me what it sounds like in kind of different is that trend following to me is not really about chart pattern recognition or anything like that, meaning I wouldn't pay too much attention to whether it closed below the bar that made the breakout. That to me is not really that important. I think to me I would turn it around and say, well, if what you're suggesting, really what it is in reality is you're moving your initial stop closer to the breakout, then I think you can, at least in my experience, there's a very clear line. At some point when you move your initial stop too close, you simply get too many failed trades, and so the results don't, it doesn't become a profitable suggestion to do. You need to let your trades have some breathing room in the beginning, I think. And sometimes trades that don't look that promising in the beginning actually can turn out to become really great trades, because there might be an initial kind of push to create the breakout. but then the markets takes a little bit of a breather for a while, and then something else pushes through, and then everything goes in that direction. So I know what you're saying. I think if you're looking at charts, it kind of makes sense what you're saying, but I don't think from a pure trend following point of view, that it's something that I think there would be a lot of mileage in. That's my guess at least. But it's easy to test, I guess.
Yeah, no,
Boris,
no, fair enough.
just one quick thing. What I do, I actually use a data mining process to define the distance away from my initial stop and trailing stop. So if you could imagine, this data mining process looks at these extensive data sets. I'm talking 50 years of history across 30 markets, because I'm using a multi-market approach. So I throw this amazing amount of data at it, and that tells me what that data is saying, how far away to put your trailing stop, how far away to put your initial stop. That data tells me that you don't close your position out if it immediately goes in the wrong direction on entry, irrespective of whether it hits your stop. It actually it defines where that stop and initial stop is, and it's always multiples of ATR away. So that to me sort of confirms the research side, because this data mining process is effectively a data mining exercise to optimally place where those stops and trailing stops are.
Yeah, Boris,
Yeah, no,
I would reinforce Neil's point, but just to make things clear, are you suggesting that the stop should be 0 ATR from the entry, or I don't know, anything really close to 0, or only on the day that the breakout comes up? I don't
right.
know if the next day it's okay if it goes down, but if it's in the day you put the trade on, then your stops should be 0 ATR. Is that what you're saying?
Kind of. So what it essentially got me thinking, and I actually read this in one of Schwager's books. I believe one of the managers there, I forgot what his name was, but the concept was, you know, are you exit or should you exit a trade if the breakout fails? Or, are you going to let it go down all the way to your max stop loss, which is multiple of ATRs? So it got me thinking that, or the logic behind it is, if we can agree that a breakout, right, let's say 100-day, 200-day, whatever, 300-day breakout is a significant event because it's getting us into a trade, right? If we can agree to that, and that's a big if, then if price closes underneath that, right, if it breaks out or the breakout fails, then that should be enough consideration to potentially get out of that trade. Now, if it sets up again and it breaks out again, then you obviously still go along in this case. So that's the theory there behind that. Now, that would take you in and out of trades a lot more often, right? Because you might be exiting, entering again. Because what you're essentially trying to confirm is that the best breakouts, the strongest trending markets are those that take off and don't look back. They shouldn't be kind of withering away. Now, yes, you will get chopped up in the noise. You're going to miss those trades that kind of pull back 2, 3, 4 days and explode higher at that point, because you'd still be re-entering. But that was kind of the logic in the theory. Now, I've started to kind of do that, some of that testing, and the results have looked okay. I mean, but then again, I just have to make sure that all the things that I'm doing are actually correct. It's just the drawdown was a bit lower, the accuracy rate was lower. I don't think it was as profitable from my earlier testing, but I was just curious to see if anybody did that kind of work.
Yeah, from a philosophical point of view, I don't know if I agree with this. I think that when a breakout occurs, there is reason to believe that there is room for the price to go up. If it fails, I'm not sure if that's informative of that space being limited. I'm not sure if I agree with that. And from the backtest point of view, I would say that that's an additional parameter that you need to think about. What if the time you wait for the breakout to fail is not 1 day but 2, perhaps a week, perhaps 2 weeks? I don't know. You should test that too, and after testing this, you come up with one more variable to to worry about, and that hinders you from a sample size point of view. That's less degrees of freedom on your model that you need to worry about.
Yeah, so I guess in your point of how long you would wait, well, you would either wait until your trailing stop, whether it's ATR based, chandelier stops, or whether your end day low or high, whatever the case may be, overtakes that if you're in a trade. So at any point in time, if that move or the price closes below your breakout or your entry, then you would exit that trade until your trailing stop takes over. That's kind of the theory there. I guess it just piqued my interest a little bit because in theory, it's essentially what we're aiming to do. We're aiming to cut losses short and, ride the winners, right? That's in theory what we're supposed to do or trying to do. I guess the point of how much time do you allow the market to show its hand, is a bit of a tricky concept, but that was in theory what the whole concept was. And I can't recall the manager's name, but it's definitely one of Schwager's books where he talks about, not waiting for the full stop loss if the market has failed in the breakout. I'll try to find the name and come back with it in a.
No, I was just
Go
gonna
on.
say, Boris, that one of the things that I think in terms of the philosophy of trend following is kind of, knowing what we don't know and not being too clever, not putting too many rules, and not saying, oh, but the trade has to go exactly like this before it's a good trade. So I think what you're saying is you're trying to create a much narrower path for the trade to navigate. And I'm not so sure that's a good idea, because the reality is we don't know how it's going to navigate. Nobody thought necessarily that UK net gas 12 months ago was going to go up by 700% or whatever the number is. I mean, so I don't think you should try and put too many constraints on the trade. I think you should just say, here are my overall parameters. I mean, we say it so many times, keep it simple. And I think you lose some of that simplicity if you try and say, oh yeah, but it can't go below this level and couldn't do that. That's just my gut feel is that you're making it too complicated by adding these extra conditions.
It
Oh,
reduces
sorry.
your options. I used to trade non-farm payroll back in my nastier days when I wasn't a trend follower, and the way a momentum burst occurs is usually through volatility expansion, which we've talked about. But this volatility expansion does not necessarily mean it's all unidirectional in nature. So in non-farm payroll, you get this volatility expansion after the news event where you get this burst of either pessimism or optimism, but then there's always a counter move of optimism and pessimism at that time until they've decided, or there's this consensus in the way that the direction should take. So with this volatility expansion, you get moves up and you get moves down, which tends to me to say if you're trading a breakout model, you do need room to breathe when that breakout occurs, because the expansion does not necessarily go your way initially, but ideally your whole strategy is based on the principle that the asymmetric nature of your strategy with breathing room does have an asymmetrical bet applied to it in the direction, and that's the way you want that direction to go. So that's the way I see a breakout needs to play out. You can't be too prescriptive, otherwise you reduce the possible paths that you allow the uncertainty within that breakout to play out.
So just to play devil's advocate, which I'd love to do. But yes, those are fair points, both Niels and Richard. I guess the question that I'm having here is that I would completely agree, and not saying that this is the approach that I take, because I tend to let the kind of trades play out and do what it may. But you're still re-entering into that trade, right? So it's not like you're not giving the trade room to breathe, and you're exiting never to enter again. All you're essentially saying is, I just want to be part of the trades that are, have some umph behind them, right? So that's essentially what you're saying. So, let's just say that you come into a trade and you're exiting a few times and you get whatever, I'm going to start expressing this in R, and kudos to Van Tharp. But let's just say, you set your initial trade or stop loss 2 or 3 ATRs away, and you're coming in and out of these trades. The market's closing underneath the breakout. You're taking small losses, so you're taking 2 or 3, 0.2, 0.3 R losses, right? But you're still playing for that trade. You're not entering that trade again. So yes, you are just basically kind of being extra vigilant and saying that, okay, if this trade does not work out, I'm going to exit as soon as I possibly can. But you're still giving yourself the possibility of re-entering the market. You just want that move to be strong enough. So I guess, you can wait there for it to take you out for your entire, 50 basis points or whatever, 100 basis points of the trade, or you can kind of see and give it multiple tries. So I think I'm explaining that correctly. I don't want to confuse the matter too much, but
No, but I think, I understand what you're saying, Boris, but I think then, what about the next day and the next day? I mean, you're kind of saying, well, the market should always move in the direction of the trend, right? And we could just go back to an example that Jerry has mentioned many times on the podcast, and that's Tesla and Moderna, where I think there were massive, or maybe it was just Tesla, but there were massive correction in terms of give back, but it turned out to become an even better trade, right? So, if you start applying those rules about that the trade should always move in your direction, that's not really pure trend following in my view. If you restrict it like that, there's nothing. I mean, maybe it's also time frame here, Boris. I don't know what your time frame is, but if you're looking for trades that can last you several months or even years, who cares if the market is going against you for a week or two? I mean, it doesn't really matter, especially if you have a fully diversified portfolio where there are lots of other things going on and you're not trading too large. So it has a massive impact on your overall portfolio. So it may be, and I think you kind of mentioned that maybe you have some discretionary approach or you come from a discretionary background. So I get what you're. I think what you're saying or expressing is something that we would all want should happen, right? That we get into a trade and it moves in our direction straight away. And I think if you're a short-term manager, this is also why, if you look at some of the shorter-term CTAs, they don't actually do short-term trend following. They do a momentum burst, and many of them uses time stops. So they know on average that this momentum will last for 3 days, so they get out regardless after 3 days. So it's short term, it's just not short term trend following, in my opinion. I think that's the difference.
And Boris, there's another thing that I'd like to add to all the comments. I think I understood what you're trying to say. You're trying to say that you always want to have a momentum behind your back. Problem is, measuring that momentum is not that easy. But let's assume that we had the perfect momentum indicator, and then you were kind of going in, coming out, going in, coming out. At the end of the day, if you added up all the different legs of your trade, just in sheer cost, intermediation and slippage, you would have cut part of your profits. So, that strategy may be superior in theory, but in practice, it's very, very difficult to implement, and it could cost a lot more. And the only thing that we're certain about, as traders, is how much cost you pay through all the different parts of your business. So, in that respect, I don't think it's a very interesting or sort of an alluring.
yeah, those are all excellent points. And I completely those are some of the things that I was thinking about. And just to clarify, obviously I think, the majority of folks start off with a discretionary approach and you think you can kind of stare at charts long enough for it to scream something at you. I no longer subscribe to that or believe in that, too strictly at all. So it wasn't necessarily just the visual chart patterns and saying, okay, this breakout's failing or not. It was essentially applying the concept of cutting short or cutting your trades, your losers short as quickly as possible and letting those profits run. And really applying the philosophy of trend following and just trying to kind of see if there are any other ways without getting too cute with it. But I guess it led me to believe that while some concepts may be absolutely valid, like cutting trade short or cutting your losers short and letting your profits run, the implementation of that could also be wrong. And in this case, I absolutely agree with you, Bruno, as well. Like once you start adding all the commission and all of that stuff, you're essentially eroding your edge, or you're eroding that cutting of those trades. So I completely agree, and those are absolutely fair comments. And just something I wanted to bring up to see if anybody actually did the data enough to kind of, I guess, prove the philosophy wrong, or the concept wrong of cutting those trades like that. So those are great.
Well, I mean, everyone's kind of piled on. I'll take it differently. Although my conclusion is the same, I came to a different idea. So imagine you are staring at a chart and you have this bar. What if the bar is super small and it just gets above the breakout the next day? And what if the bar is super large? What you have, let's assume you just have one trailing stop, whether it's a chandelier style or a breakout style, it doesn't matter. And you have this stop. It's equivalent to having a hard fixed stop that is random based on the size of the bar. And it is the normal trailing stop that would be the rest of your system. That randomness you don't want. Now, we know that having a fixed stop with a trailing stop does work. But the idea that you want to have it based on some random time candle thingy, to me, is adding this extra noise, regardless of you want to have a smaller fixed stop above your trailing stop, because that we know works. The issue is then, is the size of that stop within the normal volatility of the instrument? Is it in the noise? And the probability that a single bar is going to be within the noise of one bar is very high. So unless you get some kind of already outsized move that creates a breakout that moves that bar up so much that it's outside of the noise, you will absolutely be whipsawed. And we don't need to really kind of test that, if that makes sense. If we can just start that as a fixed stop, if you think it's like 10 points or whatever, I don't know, whatever, the volatility is 25, you're probably going to be hit even though it was a good trend. And so you're getting within that noise range. I guess that's how I kind of solved it, with a thought experiment rather than actually back testing. But I do know that having too tight fixed stops that are inside that noise threshold do result in losers that could have been winners.
Great explanation, Derek.
I like the thought experiments too, and I never tested that. And the reason I wouldn't test it would be simply what Bruno said a ways back, which is it lowers my sample size, and I'm already trading medium to long term. My sample size is not that high. I don't do a lot of trades, so now, and I already have a stop loss that cuts my sample size because I have to pair up the entry with the stop loss, count those trades, entry with the trailing stop, count those trades. Now I've got a new stop loss that's based upon some pattern that I preconceived in my mind. And I think that's what I don't like, is this is patterns, um, and things like if it's a good breakout, it should not look back. Um, I don't like that idea because it's not based on the back test. Um, I don't want to be a tape reader. I don't want to look at these patterns. I want to do my back test first and then say, how would I describe this? What seems to work? What is the computer telling me about this back test? Oh, I see. Take small losses, let profits run, and diversify, for instance. But I don't want to, before the back test, say, I'm going to design something that takes small losses, that breakouts should work immediately. The market needs to show its hand. No, 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 no. I'm going to be totally no clue what's going to work. I have no expectation. Um, Now show me what works, and I will describe it if asked. Um, but maybe I describe too much, and I think describing. I wanted to make this point a long time ago, and that is when you try to convince clients, oh look, I didn't have a drawdown here. It's closed equity. It's not. It's open trade equity. Don't pay attention to this drawdown. I mean, maybe that's the problem. Like, shut up. Don't say that. Because no one's going to understand it and believe you. Just do the best you can, and your performance will win out. Because treating closed equity and losing trades different from open trade equity and winning trades is a winning strategy. You don't have to talk about it and try to convince people to see it in your way. They're just saying, like, dude, shut up. Just make money. Just do what I'm paying you to do. Don't try to turn me into one of your followers. I don't think I have a theory beyond the back test and the rules that the back test approves of. I don't think I want this pattern to tell me something I don't think patterns can tell me something that allows me to avoid the sample size and back testing requirements. Um, and then another thing I wanted to say about the cost of all of this, the commissions and the slippage of this additional exit. Another thing that happens too is it's very beneficial to get on these trades sooner and hold on to that entry. And even if it gets to 99% of your stop loss, wait for the one more tick. Because you know what? I've had trades happen to me this year where I'm like, okay, I'm supposed to spread today. Should I spread to the next month? I'm almost out of this thing. Just go ahead and get out prematurely, rubber. And other ones as well, where all of a sudden I get out one tick or half an ATR before I'm supposed to, and it rallies. And you're just screwing up your expectation because you're not being consistent. You know what? Look at the back test. How many trades went 95% to my stop loss and then all of a sudden became big and profitable? Oh, yeah, I got sidetracked. When you keep getting out of these trades and having to get back in, a lot of times the ATR is increasing. So you're continuing to put on this smaller and smaller trade. And then you get this big trend and you're like, oh gosh, my first entry into Moderna, I said, was 87 cents. That was the ATR. My last entry was $2. I mean, think of the difference in P&L in those two trades, where at the end of the day, I'm just saying to myself, if I screwed around with that and did something that would make that position smaller than it needed to be, I'm saying to myself, why am I not focusing on this outlier? Why was I not focusing on hunting that outlier and taking advantage of that low ATR and having on that bigger position and concerning myself with, well, I'm going to try to save money and lose 40 basis points versus losing 50 basis points?
Yeah, no, just fair comments. Just to add, if anybody's interested, the manager was David Ryan from Market Wizards. I think it was the initial book there by Schwager, where he talks about that type of stop.
People ask me over the years, like, tell me a book, tell me some books that I should read. And I'm like, oh, Market Wizards. The first two are amazing, and I think they are great. And I don't think there's anything better than listening to and reading interviews of good traders. And he picked some very good ones and very successful ones. But I think since then, I have not been a fan as much of listening to interviews and podcasts and webinars of all traders, because they do have some bad ideas. And I think at the end of the day, they're ascribing um, some of the benefits of some of the bad ideas into their performance, when it was just basically they got a hold of a big trend and didn't get out. And so I'm more cautious about listening to what people say about what works and doesn't work. Rightfully so, because people should be cautious of what I say and because I change my mind sometimes. So you have to make it. But I have it easy because I, from day one, was told that there's nothing more important than sample size and a few rules and variables and parameters versus many. And I just really believe that. So I'm always being very consistent on talking bad about ways to improve things.
But I also want to just add one thing about Jack Swagger's books, and I also like a lot of them. But even when you ask him, he's going to say that most of the traders he's ever profiled are not systematic traders, and I think that makes the difference.
Yeah, the great thing about all of this is that, with the data and the programs that we have these days, we can kind of backtest all of these ideas and see what it looks like. Not to say that that's what it's going to look like going forward, but we can just say that that's what it looked like. I think, I guess, on the topic there of, Schrager's latest book and just discretionary, there's this feeling there, or thinking that discretionary traders, good discretionary traders, and there's, I guess, in the minority, can outperform or outtrade systematic traders because they technically have an edge that can be replicated, whether it's a visual pattern or something that they see, I guess, that nobody else can see. And I don't know if I subscribe to that. Definitely know a few discretionary traders that prove me wrong on it, but I guess there's that allure of doing something or having some sort of a personal system, a discretionary system that can outperform.
I like the words of Niels in one of the episodes, maybe 1 year ago, of Top Traders and Proc Systematic Investor Series, and he said that it's not repeatable success. I don't remember exactly these words, but it's important words that, the sense of it that it can be very big success, very big profits, but this success isn't repeatable. There is no evidence. There is only evidence we can see. It's the evidence of a systematic trend following funds from long term, from medium to long terms, and there is no such evidence that long track records, many years track records from the discretionary side.
That's a good point, Oleg. Like when I look at the performance history of fund managers, we know that discretion has been in play a lot longer than systematic methods, but yet the track record doesn't reflect that the balance of profitable long-term traders are discretionary. The balance always shifts towards, by far the majority of those traders are fully systematic. So I wonder how you can say that someone has been successful if they've been lucky. This is where I sort of have my real concern with approaches that adopt convergence, because those approaches are successful over a particular market regime, and we're all sort of predictors. And if, for instance, I elected to adopt a convergent premise, I probably could make a cash flow over a particular period that displayed this rhythmic tendency. I could use methods of quantitative statistics that allow me to determine that predictive pattern and trade that. But I've elected to actually throw that in the bin by virtue of the fact that there's this uncertainty, and there's always a timing issue when you are trying to trade a predictive tendency. And this timing issue is effectively the reverse of the volatility we get in our equity curves. The reverse, or the negative implications of convergence, is the negative skew, which is this non-linear feature by virtue of the fact that the predictive method was outshone by what the actual market wanted to do rather than what the trader wanted to predict it to do.
And I didn't understand Jack's comments as it relates to most of the traders are discretionary, because a lot of the managers he interviewed, especially in the first two books, Richard Dennis, Paul Jones, Bruce Kovner, I mean, were they systematic? Well, Richard Dennis definitely followed rules. Paul Jones probably followed rules. He talks about the 200-day moving average a lot. Kovner, who knows? I mean, I think it's a little misleading. I mean, I think the whole concept of discretionary and systematic it's a blend where people have their ways of looking at the markets, and it's not random, and it's not all fundamental. So I think a lot of it is, based upon the concepts we talk about, but how rigid are they in following a certain set of rules? I'm not sure if, but I do think that the vast majority of, if you want to stay alive in the markets, it's difficult to do that if you don't diversify and take small losses minimally. And I think those are two pretty darn good rules that I think a lot of people who've survived and prospered have applied to their trading. So I'm not in this last book. I mean, I think some of the rates of return of some of these people I put into a spreadsheet, and 330% a year, averaging 300% a year for 13 years. I mean, how much money is that? Is that possible? I was really shaking my head at this last book.
Actually, he talks a little bit about that on his latest interview with Brian, or not Brian, on Rithol's Master of Business, and some of these traders where you also, as you say, you scratch your head about the returns. They weren't compounding their investments, so in real time, in real money, it actually wasn't as big as you would think. But I think the key evidence, Jerry, to what you said is just go and look for track records that are 40 years long of discretionary traders compared to systematic traders, and I think you find your answer.
I want to say that I saw a little funny announcement of a trader of his system. He was telling about his system, and he said there, I don't remember exactly, I don't remember who this trader is. It's small trader, small manager, and he said that he is short-term, maybe intraday trader, and I thought, oh, it's not a good situation for him and for his investors. And after that, he ruined his account, and he said, I understood that I was wrong, and now I'm a discretionary trader. And I thought, oh, it will be maybe the same situation.
I guess the one thing as well is, there is obviously discretion within the systematic realm as well. I think we've kind of discussed it several times there, but whether deciding to cut, trades because the market has exploded, however you want to define that, and you're trying to, keep an eye on your risk or whatever the case may be, there's still discretion there. I mean, there's discretion in the inputs and the parameters that you use. There's discretion, the philosophy that you apply. I think one thing that kind of gets into trouble is not trouble per se, but, and this is a question to everybody here, how many so-called retail traders that don't have a six-figure account can be successful trend followers? And I know Neil's obviously the suggestion, which was a very good one, was, well, might as well just take the money that you do have and, try to invest in an ETF or, with a manager potentially that can diversify, that can achieve that. So while the concept and the theory, of course, of trend following is absolutely valid and absolutely works, and especially if you have a bigger account, I think it tends to turn off a lot of the traders that just are not able to have a $500,000 account or $2.5 million account and diversify and get those benefits that we need. So obviously, when you have that discretionary approach, or when you have that concept of, well, you can start off small and build your account or do whatever the case be, most people are going to bite at it. Not saying at all that I agree with this. I'm just throwing perhaps a different approach there of why trend following in concept and in theory is absolutely fantastic, before the crowd that I guess Schwager is talking to might seem, out of reach.
I think that there are a lot of tools now to get rid of that, whether it's CFDs, although you have high counterparty risk, high cost per trade, like given the instrument size. Mini contracts for at CME have been getting better for some time. They've got the micros now. I don't know how liquid they are. But okay, you can replicate with some ETFs, but be sure to read their prospectus to see how the rebalancing works. And there's a lot of ETFs that gives you exposure. I think there's a different problem than the issue of systematic or not. One is you've decided on the strategy and you need to find the best way to implement it given your capital size and the exchanges or counterparties you have access to. The other side of it is, what is the allure of discretion? It's feeling smart. You want to feel like you had control of this thing, you knew better, and that you were able to get out of it. I can tell you from my personal experience, I don't ever want to interfere with my system, and I haven't in years. It just goes through its thing. We do our normal checkup cycles. That's when the thing comes online, or we make a change, or however it goes through the funnel peer review process. I I have put so many barriers in the way for me to be able to adjust that kind of parameters to interfere on a daily basis. But you're absolutely right. We are all here because we have a bias towards trend following. Our systems will be biased in that way. That is the implicit bias that you have. But those barriers reduce the emotion, and like you said, we've done it before. But the the bonus you get for that, or potentially screwing up your system, is just feeling smart. It's not more money. And what I'm I wrote a tweet about it. Are you playing to play? Are you playing to win? If you're playing to play, and you are playing because you want to feel smart, you want to have entertainment, you want to be able to tell all of your friends you're a day trader and you earn massive amounts per year or whatever, that's non-compoundable or whatever, that's fine. You're playing to play. But if you're playing to win, um, and all of us do have a general idea of how that is possible, um, you need to execute against that plan, whether it feels good to you or not. um, I don't think that anyone is going to take a personality test like, what is it, Myers-Briggs, and say, "Oh man, I really need to optimize my system's parameter to match my Myers-Briggs test." That is not like I don't think anyone is actually doing that. But you get what I mean. It's an over-the-top example, but you have to understand why you're playing this game, and everyone is playing it seriously. No one is putting their money in the market and saying, yes, I'm just going to close my eyes, hire six monkeys and flip a coin all at the same time. There are serious players in the market who will take your money. This is a negative expectancy game, um, unless you trade equities. But yeah, that's my.
I don't want to give off the impression here and get burned at the stake by the fellow trend following disciples here that I'm reading charts or anything of that sort. But all jokes aside, Derek, I actually found that in my experience, it's actually quite opposite. Most of the discretionary traders that I found are in it to make money, and they think that that's the best way to make money because they think that looking at a chart, it's easy, and then potentially there's a concept or there's a theory here of being smart. But I actually feel that maybe a bit judgmental here, but I feel that where people like to look smart is the people with in this field in finance with designations, with the 17 designations behind their names, who focus a lot on building models and the presentations that sound smart and everything checks out and the math is great and everything in theory looks good. And there's that, pat on the shoulder to say, wow, that's fantastic. I actually feel the people there, and that's, very systematic approaches as well, is from, at least from my experiences, where people are more likely to feel smart. But I do get your comments, and obviously the feeling there that as a retail trader you're able to outsmart the industry by picking up a few dollars here and there. There's definitely that, but I don't think it's just mutually exclusive to the discretionary.
My
Oh,
experience in the retail world has been that if you present a random chart to a retail trader, they will have a very, very hard time being able to discriminate whether it's a random or a non-random chart. In other words, real market data or random market data. And that in itself tells me a big clue. And, it's all about, to me, can you basically extract an edge from the visual data that's presented on a screen? Because that's what discretionary traders tend to focus on, the technical analysis side. It's whether there is an edge in that visual data. And I'd actually argue to the contrary, that the noise within that data series itself is sufficient to create these illusionary sort of features which trap the discretionary mind into thinking there's some causality in it. So I tend to view that a retail trader who has managed to be successful with these incredible returns is a sort of ephemeral phenomenon of luck associated with high leverage. And I think all of us, if we're lucky enough, can achieve a significant equity curve for a period of time. But I think ultimately this edge is something that is a result of accommodating many different regimes, and the ability of a discretionary trader to do that with the ability to generate this consistent edge over these multiple different regimes, I think is a real hindrance. So I just want to see, who are these retail traders? What is this validated record? Because if we could justify a 30 to 40 year track record of them, then I'd accept with grace that I'm wrong, but I just don't see it.
I want to disentangle what Boris said, and I'm definitely not trying to burn you at the stake. I do feel I have been on the receiving end of the group's ire multiple times, as I too like to do the contrary opinion. But the charting is the issue. At my current firm now, I'm surrounded by discretionary traders. I'm the only systematic team. I have worked with many discretionary traders who have been who have 20, 30 years careers doing, taking decisions and being profitable at it and generating returns for their clients. But what they do and what your normal person, retailer watching YouTube drawing spaghetti lines, all full offense intended, is different. They are targeting very specific outcomes. Whether I do think that fundamental is a bit weak these days, but they are able to identify specific opportunities in specific markets, whether that's studying the underlying or having a better knowledge of the industry or having some kind of connection that allows them to analyze some upcoming binary event, or knowing that an event is coming, or understanding the shapes of curves. I mean, there's a lot of that going on in fixed income, or policy decisions or things like that, than staring at a chart. I would say for them, the chart is like the last piece of the puzzle, where when you see a retail trader, normally like on FinTwit or whatever, the chart is the strategy. And these people are exploiting specific situations that come up because they know how to identify them, and they may use the chart to set their stop loss or set their target or whatever. But that's at the very end, and it's very minor. If you change their stop loss by plus or minus 2, 3, 5%, maybe, as long as it's within their risk budget, it wouldn't really affect their trade so much because there's something else happening. And we don't see that coming from the retail crowd.
Yeah, so most of the successful, I guess, discretionary, and whether they're lucky or not over a period of years, I don't know, but they've actually managed to do trend following in a very discretionary way. Ironically, actually, they'll wait for a strong thrust or a strong move to the upside or the downside, wait for a pause. However they define that, I guess the term is pullback, and then they'll enter the trade when it continues going in the direction of the original move. Now, how they inspect that visually, how they categorize that, that's most discretionary traders that I personally have known that have some sort of success. They've managed to capitalize on that. Obviously, we're not talking about the YouTube crowd. We're not talking about the support and resistance. I think, even with things like futures, when things roll over, what you saw was resistance and support was not really resistance and support because you weren't looking at the right price. But I have a hard time just, discrediting, or not discrediting, but saying that there are no successful discretionary traders, that they've absolutely been lucky for the last 10, 12, 13 years. I think you can identify certain things. Now, I personally can't. Maybe I don't have that skill or talent. I think there's a severe amount of self-discipline and luck and all these other type of things that have to go with it, and that I just don't want to even deal with. But I think there's something there. I think there's something there of being able to visually identify momentum on a chart and entering that trade? Um,
My answer to that would be, yeah, they're probably exploiting the same thing we're exploiting then. If what you're talking about is people who are manually identifying trends or momentum, both of those things exist in all markets. They are exploiting a factor that is well known and should pay you out based on the risk you take. So, yeah, sure. The question is, are they exploiting it optimally? And that comes to could you code up their system and in fact show that yeah it is profitable because they are catching trends just in a different manner than we are as breakout. Maybe they're doing some kind of pullback thing like you mentioned. Sure, that's fine. There are counter trend systems that can work. That's true. That end up taking the trade the trend. Sorry. Um, the issue then becomes if you could code it up and systematize it and they are following a system, then you might as well just do it that way because you would remove the human random element, and we all have emotions sometimes. Making zero mistakes over 1,000 trades, and you're making a mistake every 50 trades or 100 trades, which is pretty good. You make a mistake 1% of the time. That's negative edge right there that you would have better. And I would guess that you're probably right. The people that are doing discretionary things are targeting some kind of factor or phenomenon that is well known. The question is just, are they doing it the best way possible? And I think with the tools now, that's probably not the best way, if that makes sense. If you had rules anyway for the
I think where I see them optimizing things, I guess, is just this trailing stop, right? Whereas we're using more systematic trailing stops based on volatility, based on the end day low or whatever. Successful discretionary traders that are tapping into that trend following phenomena are actually able to trail the price or trail their move a bit more efficiently or effectively, I guess, to keep more of the profits. I know Jerry does not like to hear that, but that's what I saw. Now I don't know about any other type of discretionary trading of weird chart patterns and head and shoulders and all these things. That's not what I'm talking about. I'm talking about just identifying things, like I said, more so in line with exploiting market dynamics such as trend following or even mean reversion in the equity sphere, especially that tends to net an edge. I don't know how long or how much long you could do that or why you would even want to do that because you'd be staring at the screen for a very long time. That's completely a separate issue, but just wanted to bring that up.
And I think that my point is very simple here. I think that if even theoretically a person has a prediction ability of 90% or 99% of that event will occur, and he has a concentrated bet because they have concentrated bets, and I think that sooner or later something wrong will happen, and because of his concentrated bets, he will ruin account or have a big losses. And I'm sure it will be so because there are no robustness here. There is no robustness, and it will lead to losses even with a very high prediction ability.
I think it's going to be very difficult to find someone who can effectively discretionarily trade the amount of markets the typical systematic trend follower can do. I just don't think there's enough bandwidth in someone's brain to visually trade 50, 75, 100 markets and do it effectively and uniformly.
By the way, very interesting point, but they don't have such a target. They learn about one or two markets and think that they can predict it, and after that, they think that they can predict it, and after that, they trade and lose their account.
I'll actually fight back against that. Position sizing has nothing to do with if someone's managing their edge or their entry or exit. Um, People don't necessarily need to oversize their position. I mean, I think most people, probably at least on the internet, from my searching, they say risk 1 to 2%, which is quite high. That's granted, especially for us. But that is a different thing from their edge. And if what I'm hearing is true, and I bet it's so, these people are exploiting an effect that really is in the market, in my opinion, potentially suboptimally. Maybe they do have some knowledge that's better than a back-tested system, because back-tested systems are not able to adjust to each event. But then we're saying that each event is different, which we know from statistics is probably not the case. Um, but it would be possible. Like, you could imagine that you trade a mean reversion in equities. That is a well-documented fact, that there's 30 years of papers published about this effect. Um, so then there is really an edge there, and just the question is, are they able to optimize that to capture it the most, and are they able to risk control themselves to allow them to have these 10, 20, 30-year potentially track records, is a different question.
Yeah,
Excellent
that's a
point,
great
Derek.
point.
One of the things I've found is that in the retail trading world, a lot of discretionary traders, they actually probably do exploit an edge. Maybe, but what happens is that they tend to apply excessive leverage. So what that does to their equity curve, as we all know, is it creates this incredible volatility in the equity curve, which they can't stand, and it often throws them into risk of ruin. So even though there is this explicit edge that resides in this equity curve, the volatility of that equity curve through this excessive leverage is the thing that wipes them out in the end. So that's where systematic processes and a back test come in line to be able to say, well, what is the level of leverage you need to apply for your strategy to extract that weak edge that might exist in the market of noise and mean reversion, etc. There's this weak edge in the market, but I think people think that the edge is far higher than what it really is, and it encourages them to amplify their trading risk exposure through leverage, which I think is probably one of the biggest problems in the retail trading world. They're over leveraged.
This is a question actually I'll pose to the group, and maybe Richard, because you seem to know quite a lot about the retail crowd. What are they actually thinking? What is kind of the baseline? This is just for my own personal curiosity. What are people thinking out there? And
Martingale and grid trading and ways to warehouse risk. That's what a large proportion of retail traders do, because they don't understand the warehousing risk principle. So they refuse to accept losses. So they're always averaging down, or they're martingaling, or they're applying this grid trading, because they believe that the markets over the course, it's a bit like going to the casino and taking a punt. You can apply a progression-based system for a period of time at the casino. And that progression-based system, basically a money management method, allows you to survive for a period of time. But ultimately, the edge is always in the casino's favour. That's what happens to these retail traders. So they have these absorbent models, which are quite complex. And I always I hang out on Forex Factory a lot, so I see a lot of these models. They're almost always, they've got a martingale component in it, or a grid trading component in it, to basically warehouse risk. And I think that's fundamentally where they come undone, a large percentage of them.
I don't really understand fully why they aren't a specialist in discretion trading. I know a little about this, but why do they think that they know enough information for decision making? Because I think that this information is can be close to. Maybe we must not know this. We cannot know this information about real situation in the companies or commodities markets or forex markets. It's especially very difficult to understand what is going on in politics, so on and so forth.
So just to clarify, when we're saying discretionary traders, I mean, I think we have to be on the same page of what we mean by that. Let's take the example of a pullback trade, right? I think pullback is or a pause in a trending environment, right? I think if you run the back test and if you run the data, there is an actual edge. It's very small, right? And you can argue that pullbacks or pausing and so forth is just random noise in a lot of charts and a lot of trades, and that's absolutely true. But there is, an edge to that type of trade. If you can identify a trending or a strong momentum burst and a pause in that burst, the chances are that that burst will continue in the direction of the initial thrust, right? You can backtest that, and you can kind of see if you can
I'm going to pour
identify
some
that pattern.
petrol. You're on a cross at the moment. Jerry's about to come in and light the torch that puts the fire to the cross that you're hanging on at the moment. If you keep on talking about retracement entry into trends.
Yeah, no, I understand that I'm in dangerous territory here, but the point, I guess, I mean, I don't know if I don't want to make it to mean that I'm making a point that discretionary trader is better or not. I'm not at all. I guess as a trend follower, I am, of course, but I'm always a little bit hesitant, and I guess I could throw these little things in there about the absolute allegiance to it, and the point of discrediting other approaches, because I do think there is some merit in other different things. So I just kind of want to know what the group's experiences are in that. I think we got to be kind of careful when we say discretionary traders. I'm not talking about the YouTube traders, telling you can make 400% return a month. I'm not talking about that.
Yeah, look, I know I'm a fanatic, and Derek continually reminds me of that. So I've got to sort of relax a bit. But I do believe that trend following is superior simply because it's attacking this non-linearity in a diversified way. So my reasons for that are based on a sound scientific principle of non-linearity, amplified returns. That's why I believe that this approach actually generates a superior long-term wealth profile. And my philosophy is that I understand these markets to be these complex adaptive systems that at times they're non-stationary. So at times they do really strange things. And unless you manage risk at all times, you're a survivor. And you attack this non-linearity, it is a superior method. So that's what I mean. I don't mean to say that there are not alternative ways to extract alpha from the market. I do believe there is. I believe there are convergent edges. And all of this thing, but I just don't think that they're as good as what we're achieving.
Well, I think I will say, kind of reinforce Boris's point. There are definitely many ways to make money. Definitely different risk profiles, and Richard is definitely a proponent of the positively skewed profile. I would say 90% of people in finance are using the convergent system, and many of them are billionaires. Many of them run large funds. Um, hundreds of billions, I would say maybe even trillions, are in conversion strategies in our world today. That I don't think you can be fanatical about a system. Many people can make money in different ways. It depends on what you're trying to achieve. Do you have the infrastructure to do that? Are you risk controlled? You're going to have to go through the whole same process. Um, Convergent strategies have their place. This entire world is based on strategy. Fixed income is a convergent strategy, because you are paying something now, guaranteed returns, and you take all of the volatility until payoff if they don't default. On that idea, equities are actually a short volatility play. You're selling your ability to get paid off because you're in the lower tranche, and then you take on that risk of it going to zero, and you're giving the upside basically to the owners of the company at the IPO. And that is something that people don't understand. That is why equities have this upside bias. It's like baked into the cake. And it's only because we have this Fed put, okay, I'm going on a bit of a rant here, that allows this convergent strategy to not fall apart. The system is so built on this that we as a society have decided to protect this very specific convergent trade. Now, not everyone can be divergent traders. There are multiple edges in the market. They all have different risk profiles. You don't have to have a convergent profile. Trend following isn't the only thing with a divergent profile. There are volatility edges. There are kind of other ways to express this type of payoff, because the divergence comes from the payoff, not necessarily from the strategy. Some people are able to create hedges that have this fact. In fact, all hedges should have a divergent payoff. And you can hedge with many different things. Like gold it does go exponential every once in a while, and that does help these types of things. And holding a 10-year treasury was something, or a 20-year treasury for that matter, was a convex payoff when the interest rates were, say, at 10% or 5%, because you had the duration. That duration creates an accelerated rate of capital appreciation. So you don't necessarily need to get it from trend following, although in this current rates macro environment, I would say it's a good way. It's also very accessible. The rules are well known. There's many books about it, and I do believe a retail trader could probably execute it better than in any of the other strategies I had mentioned.
So if we were to define discretion or discretionary trading as basically just allowing some degree of freedom or intuition in the whole trading process. So whether that's, the markets have gone crazy and now I'm going to start exiting my positions or whatever the case may be, can we say that Jerry might be a discretionary trader? Or any of us, if we do that?
I tend to define discretion as the distinguishing thing between discretion and systematic is, can you backtest the technique? If you can backtest it, then I'd class that as systematic. If you can't backtest it, I'd class that as discretionary.
I would say yes. We all are, no one is perfectly systematic. I have had to intervene in my systems before several years ago, but that means I did it. And that is a step away from ultimate systematic perfection. So we are all on some gradient. The question is, Boris, not necessarily about the edge, but does that person's decision have additional edge on top of whatever it is they're exploiting? And that's assuming they're already exploiting it optimally, because they have to be their, whatever their setup is or whatever their trade is, they need to be exploiting and structuring that trade optimally, and then somehow they're able to extract a little bit more juice because they themselves have that extra degree of freedom. It's not necessarily the edge we're talking about now. For the discretion, it's you must have some like extra special skill that is provable over some, we'll say 100 trades, because being a manual trader takes quite a long time. We'll say 100 trades, you're able to prove that, like, yes, I can beat my back-tested version of this factor because I made better decisions over hundreds of trades.
Yeah, I
Another
completely
way
agree.
of saying what Derek just very eloquently summarized is this, and going back to edge, a discretionary trader, the likes of the most successful speculators, so throwing everybody like from George Soros and up, they have an informational advantage. They know how to react to information faster, better, more efficiently than others. Systematic traders, besides being able to fully articulate in a programmatic way their trading, but they have a behavioral edge. As Richard keeps saying, you're fishing for big outliers, and that's something that requires a certain way of behaving, taking losses until the big gains come. This is not for everybody. And if you see the fact that I corrupt my trend following with all sorts of things in order to try and mitigate that, just gives you enough information of the difference between a discretionary trader and a systematic trader. Systematic trader goes after a slightly different edge.
Guys, it's coming to about 2.5 hours. I think I've been able to capture the recording of this entire thing, which is pretty unusual. For the last 2 weeks, I haven't been able to get the technology to do it, but I think this time I've wrapped it up. So, look, I might have to leave now, but if you want to keep on going, please continue. But thanks very much for the session.
Thanks, Richard.
Awesome. Thanks, guys.
Thanks, guys. Bye-bye.
Thank you.